I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's a senior vice president and derivatives portfolio manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Well, thank you, Jim. Good to be back with you.
Boy, what a different song we're hearing from the U.S. Federal Reserve. 3 months ago, they were hiking rates, and now they signal they may not raise rates for the rest of the year. Maybe one might be sneaked in next year, but is that likely?
I think what happened here is the central bank, the Fed, and certainly other central banks as well have done a 180. I mean, back just over 3 months ago in mid-December, the Federal Reserve raised rates and told us they were going to raise rates again at least twice in 2019. That they were going to continue with the reduction of the balance sheet that they'd built up when they were trying to stimulate the economy. And then, just like backpedal like crazy, it seems. I think at the root of it, if we look at it from the high level, as it were, the central bank, the Fed and the other central banks are changing their tune because they're getting increasing evidence that the global economy is slowing. This is an economy that's been expanding since, say, March of 2009, thereabouts, when we made the low in the stock market and have had this tremendous rally for the past 10 years. There's been trillions of dollars worth of stimulation from central banks around the world to support this. And since they changed their tune, we've had a terrific rally in the stock market. Let's just use the S&P 500, the Dow Jones as a benchmark for stock markets everywhere, and say, they're up about 20% from the lows we saw in December. And that is despite the slowing economy, but it's because, the stock market loves the thought of lower interest rates. And speaking of lower interest rates, I mean, we've got lower interest rates virtually everywhere. We're now back to about $10 trillion worth of sovereign debt that's trading at a negative yield. The German 10-year bonds are trading about 0.05 negative yield. 10-year treasuries in the United States are at a 15-month low yield of about 2.4%. And real yields, that is what you get from, investing with a U.S. government bond after you subtract out the inflation, real yields have fallen from about 1% to about 0.5% since the lows back in November. And of course, everybody's been noting the inversions of the yield curve and what that may mean. One other thing, volatility in the bonds and the foreign exchange market here the past few weeks has been near 5-year lows, although that's certainly changed lately in the bond market. So maybe we can take a look at individual markets if you like.
Aren't mortgage rates really set more by the bond market than by the central banks?
Yeah, I mean, certainly the government isn't in the business of issuing mortgages, although, of course, we've seen central banks in different places around the world buy mortgages out of the markets as they bought securities, and in some cases, like in Japan, actually buying ETFs. But the banks in Canada are going to base their mortgage rates off of the government bond yield. Yes.
An analyst said that he didn't think that the big banks in Canada were good financial buys right now because of the threat of lower interest rates.
Oh, like to buy their share price?
Yes.
We have seen in the past couple of weeks, in particular, we call it the bank stock index in the United States has had a sharp fall relative to the rest of the market. And, if the bank stocks in America are weak, that puts some pressure on Canadian banks as well. one of the things there is, just broadly speaking, if interest rates are falling, then the spread that the bank makes between what they pay depositors to put money in the bank and what they can lend it out at shrinks, and that shrinks their profitability. So that might go to why the analyst is say negative on bank shares right now.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Victor Adair. Victor, when we talked earlier this month, you thought the big rally in the stock market since Christmas was running out of steam. Is that still the case?
Yeah, I actually think that what we've seen since December has been kind of a classic bear market rally. I mean, you remember the stock market, again, the major benchmarks in the United States were making all-time highs in early October of last year, and then fell like a stone into the Christmas lows. And of course, that fall off was accelerated once the Fed came out and raised interest rates on the 19th. I mean, it was like, sticking a knife in the market. And that we made the lows there, and then we came rallying back here. Since then, I'd have to say I've underestimated the power or the momentum of the rally back. I thought maybe after 2 months or so the thing had gone far enough. But we've seen, for instance, retail, and let's just use that expression to describe people that are trading for their own accounts going in and out of the market, seemed like they were bailing out of the market in December when it was making lows, and now they're calling their brokers to say, get me back in. Some of the people that judge sentiment in the market will say the public buys the most at the tops and sells the most at the bottoms, and so, that's kind of an indicator that I would use. Also, in the fourth quarter of last year, we had record-level corporate share buybacks. And, of course, this is becoming a bit of a political hot potato. But it looks as though, coming in the first quarter here of 2019, that there's even more share buybacks. So that's helped goose the rally. One other thing is, it seems as though, some of the indicators that I look at, that relatively nobody is short this rally. Now, obviously, some people are, but in terms of, it being a really hated rally with short sellers really hitting it, that's just not happening. So it's been kind of a one-way street off the Christmas lows. I think I'm seeing some technical signs that the market is toppy right here, but you can't bet the farm on that either.
Over the last a year or so, when we've talked, you've been generally bullish on the U.S. dollar. Is that still the case?
Short answer is yes. I mean, the U.S. dollar has been trending higher for about the past year. Now, I'll grant you that over the past 4 or 5 months, it has been choppy. I mean, it's just kind of up and down and up and down. And maybe that's one of the reasons that we've had the volatility component, or the volatility metric on the foreign exchange market is at 5-year lows. It's just been sort of going nowhere. But if you back away a bit and look at the chart from a little longer term perspective, it kind of goes to one of my favorite thoughts that I've had for years, and that is capital will flow to the United States for safety and for opportunity. And it seems as though the market's a little jittery in terms of risk right now, and I think that's drawing some money to America. The interest rate premium that the United States Treasury market had over the Eurozone government bond market was way out, like really wide. The U.S. had a huge yield advantage. A few months back, that has shrunk considerably as the U.S. Bond market has fallen in yield, but it's still huge. So that's a factor. I'll tell you a couple of things that I'm watching. Certainly the Chinese exchange rate with the U.S. dollar. Chinese currency has been strengthening here. Let's call it the last couple of months or a little better, showing signs that might reverse, and that'll be important for a lot of, call it, the other foreign exchange markets around the world. Turkish lira has been really hit lately. I see Brazilian real getting hit. I think there is a risk of the U.S. dollar rising, and given that it's been kind of chopping sideways over the past 4 or 5 months, if it breaks out now to the upside, that could give us quite a kick to take it higher. And I'd say that the emerging markets and the commodity currencies, that's including Canada in a way, are let's say, at risk, as well as the Eurozone. The Eurozone just kind of, to me, just perennially looks like a disaster waiting to happen.
The Canadian dollar's been trading on either side of 75 cents this month. If you're bullish U.S. dollar, does that mean you're negative Canadian dollar?
Short answer is yes. I think 75 cents on the Canada is still too high to find some sort of an equilibrium. Just this week we had the Reserve Bank in New Zealand kind of surprised the markets and said, we think the next thing we're going to do is cut interest rates. Well, the bank, and they had previously kind of been maintaining or leaning, let's say, toward we're going to raise rates. Bank of Canada has been kind of leaning toward we're going to raise rates. The market doesn't really believe them, but maybe the next time the Bank of Canada comes out to talk about what they think they're going to do, we may find that they're positioning themselves to cut interest rates. The trade agreement that we had between Mexico, Canada, and the United States, we used to call it NAFTA, now they call it the USMCA, that may not get signed. It seems as though the Democrats in the House in the United States don't want to go along with it. Christine Friedland was saying, we're not going to sign off on it until the tariffs come off the aluminum and steel. That just adds more uncertainty to the business environment in Canada. The interest rate spreads, I just talked about that a minute ago, the interest rate spreads between Canada and the United States definitely favor the U.S. dollar. And, I'm keeping a real good eye on currencies as well, commodities as well as how they affect the currency markets. And Canada is very sensitive to commodities. We've had kind of a run-up in the currency price here the past couple of months, again, as stocks have gone higher. I've got a view here that Canada is probably rich at 75 cents. I'd be looking for it to fall off, and I'd be looking to trade that way.
We'll have more with Victor Adair right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, the gold market hit a 10-month high in February near $1,350. As we speak, it's trading below $1,300. Do you think gold goes higher from here?
I think longer term it does, and the single most bullish argument for gold, I think, is what my dear friend Martin Murenbield, who writes the Gold Monitor and has done that for 30 years, he calls it monetary profligacy. The gold bugs would call it money printing. It's sort of the same thing. And what we've seen here is the central banks around the world are getting worried again, and the market's thinking that what they're going to do is just ramp up the accommodation, money printing, buy securities of the market, do what they can like a mother hen to try to stimulate the market or at least keep it from falling. So that's a bullish argument for gold. I think maybe longer term. Short term, I just mentioned a few minutes ago, we've seen real interest rates fall in half. This is U.S. from about 1 full percentage point down to about half of a percentage point. That's bullish for gold. The U.S. dollar really hasn't been going anywhere. So, maybe that's not a headwind for gold. And I think when we had the stock market really under pressure, particularly back in the November, December period of time, the gold kind of got a bit of a safe haven bid. Okay, you can almost feel there's a but coming. And the but is, this may be kind of a sign that this is as good as it gets for gold. I thought, we had a trend, an uptrend in gold from early November to mid-February there when we hit the high, and then we broke that uptrend, that 3-month uptrend. And I think technically here, if gold falls back below the 1280 level, which has been the low twice this year, so we trade down below that, make new lows, I think we could see gold skid off some more. And what could be a catalyst for that? I think the U.S. dollar breaks out of the upside, could put some pressure on gold. So I'm positioned here with the trading that I do for my own accounts, looking for the gold price to fall. Now, it did drop $20 today. I checked the volume on it. It didn't seem to be a high volume break, but I do note that Palladium, which has been on a hell of a tear the past few months here, has dropped $200 an ounce the last 3 days. That may have had some spillover on the gold market. I don't know. It was kind of a surprise today to see gold just kind of give up the ghost and slide for $20. So I think gold short term's at risk of going lower. Longer term maybe means to me over the next year or two. I think monetary profligacy, if we really see that in a very uncertain world, very bullish for gold.
Was the palladium fall due to a declining auto market because they need it for their catalytic converters?
Oh, I think, here's what happens, okay? Whether it's lithium or cobalt or maybe something nobody ever heard of 6 months ago, the public gets their teeth into something and the story gets built and prices ramp up. So palladium, it had a good story. A lot of people got into the market, and, you see this, you could go back to cryptocurrencies, right? They had an incredible run to the upside. The run in palladium's been nothing like that. But then when the market topped and started to fall, there's no buyers, or they become sellers, and down it comes. So in terms, I can be kind of cynical about when a story gets told to stimulate buying in the market, and then when the price starts to fall, it's like, oh, well, I guess the story changed. There's just not much there. We've seen a $200 decline in palladium the last couple of days. If you own it, you're wrong over that period of time.
In some of our previous interviews, you've linked crude prices to the ups and downs of the stock market. If you're bearish on stocks, does that mean crude's on its way down?
There has been a really interesting similarity in the turning points, say, of crude oil and the stock market. January of 2018, when we were then making all-time highs in the stock market, and it took a break, crude oil kind of went down with it. Certainly when the stock market reached all-time highs in October of last year, and crude was trading at a 4-month high, they both fell together from October to the Christmas lows, and both rose from those Christmas lows back to about where we are now. So, is that coincidental? There's probably some reasonable correlation, although, as often happens with correlations in markets, once you kind of identify the thing, then it doesn't work anymore. So, don't bet the farm on this one either. But there's been that correlation. I think the story really with crude is basic supply demand, okay? And the bullish story has been supply is getting restricted. Supply is restricted because OPEC and friends, as I call them, have committed to cut back their production. Some of them voluntarily, some of them not so. You look at Venezuela, for instance. There's been the sanctions on Iran and Venezuela. The market's kind of been fixated on the shortage of supply story. I wonder if the reason, the Fed and the other central banks have eased policy or moving in that direction is because they see signs all over of slowing economic growth, if in fact that's the case, does that mean a less demand for crude? And if a market's been bid up, everybody believing, hey, we got a shortage of supply, and then the market starts to look around and say, well, gee whiz, actually what we got here now is a shortage of demand and prices are too high, so you could have prices break. So I'm positioned for crude oil prices to fall, like I'm positioned for gold to fall and the stock market to fall. I'm not betting the farm on any of those. They're cautious, limited risk positions, but that's what I think of those markets.
In our interview 3 weeks ago, you mentioned Boeing shares. You said shares had rallied about 50% in 3 months, and that was way too much too fast. Of course, since then, the share price has tumbled on the news about the troubles with their 737 MAX. Are you still bearish on Boeing?
I suppose generally because I think the stock market's likely to fall. There's some specifics about Boeing, but let me put this on the record. I obviously had no idea that they were going to have these disasters with the airplanes that they had. Well, I'm not pressing it that way. I'm not saying I'm a fortune teller. I had just seen that this stock, which is it's an incredible company, but the share price had gone up 50% in 3 months. It accounted for 25% of the rise in the Dow Jones in that 3-month period. It had gone clearly, in my view, up far too much too fast. And I said, if you're loaded to the gunnels or whatever the expression was with Boeing, you probably should, take some profits, write some calls, whatever, take some protection. And I just, so I wasn't picking them out or picking on. I was just saying, this is an example. Last summer, we had that same kind of thing where the FANG stocks, everybody had to own them. And if you were managing other people's money, you had to buy them, or, people take money away from you and put it with somebody else. So there was this overdoneness to it. I rarely trade individual shares. I like to trade more of a global macro thing and trade indices and that sort of thing. But, and Boeing, by the way, the last month or so, shares up there have dropped, as you just mentioned, while the rest of the market has been doing better. So it's not only down, but it's down relative to the benchmarks. But I think it's, one of my friends from years and years past is Dennis Gartman. One of his favorite expressions is, there's never one cockroach. Boeing, which had been priced to perfection, obviously, is now getting signs of being imperfect. So we'll probably see some more pressure on the stock.
Any final thoughts before we wrap up today?
I'm sounding kind of bearish here. I don't mean to sound that, I think the world is coming to an end, but, that's kind of maybe just my personal way of looking at things. I said earlier, I think it's been a kind of a classic bear market rally in stocks. Last week, the NASDAQ 100 index, the bullish sentiment got on to 95% on that. That's just extreme level of bullishness there. We've had a decade of really low interest rates, and that's caused people to go out and reach for yield, try to do something, make some money that you can't possibly make by just putting your money in the bank. When you reach for yield and you get rewarded, you reach more aggressively the next time. People take more risk. I think there's a lot of leverage everywhere. And, I'm always inclined to say, be cautious. Don't get too aggressive on things. And, here's a good way to wrap it up, maybe, Jim, is an expression from the floor down in Chicago years ago. Risk happens fast. And believe me, it does. As I say, I'm not looking for the stock market to go to zero or anything like that. I just think a lot of these markets have been gunned up on a lot of leverage, and you want to be careful.
Victor, thank you so much for chatting with us.
Jim, it's always a pleasure. I look forward to doing that again in the future.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.